Hey, thank you very much for clicking on this video and watching this video. Remember to become a VIP member by subscribing to the channel and also join me every single weekday 4 p.m. or 1600 GMT on the Business Lecturer in Within Show as I teach you live and ask you questions and answer any questions that you are having. So click the subscribe button and become a VIP member. Remember to follow me as well on Instagram at Nhyira Premium. Enjoy the video. So I think we went off possibly because of the network. I don't know, something happened like that, and then we went off. So I'm back in. I was actually giving the overview of the syllabus. Started with the contemporary issues in management accounting. If you are just joining the stream back, thank you very much for coming back, and make sure you share the video as well with others so we can together reach as much people as possible with this live stream in relation to that. Now, so I mentioned the issue about the contemporary issues in management accounting, and one thing that we mentioned was that this is a theoretical area of the syllabus, and most of the things here are going to be issues like ethics, business ethics, and I discussed that with you in relation to that. From there you come to budgeting and budgetary control, which is our main focus for today for our discussion. Then we come to the issue in relation to the short-term decisions, also another critical issues. And here, this is where we talk about make or buy, limiting factor analysis, relevant costing analysis, as well as issues in relation to break-even analysis or cost volume profit analysis. So that is also another critical section of the syllabus that you must understand. Then we come to long-term decisions. This is where we talk about the investment appraisal. I believe you know about the investment appraisal. Here we're going to be dealing with a couple of the modules here: the accounting rate of return, the net NPV, that is the net profit margin, the gross profit did I say net profit margin? Net present value, and then accounting rate of return. So accounting rate of return, net present value, internal rate of return, the payback period, and then possibly the discounted payback period. So that is also the key thing about the long-term decisions. Then we come to the standard costing and variance analysis. That is also another critical aspect that we will be looking at. And as we proceed with this master classes live on Facebook and on my YouTube channel, we will be going through a couple of them like that to enable you to prepare well for your examination in relation to that. So if you just join, comment below with any questions you have. This is a master class, so it's going to be interactive. Okay, I want you to comment below with any questions you have, and then also make sure that you comment below with anyone that you think they must be part of the stream, that they are not here. Just share the video and tag them in the post so we can together help everybody who is supposed to be helped in relation to this outbreak, so we will be on the same page in relation to that. So let's begin our discussion for today in the budgeting and budgetary control. Just want to keep my apps open. So that I can answer your questions as and when they come in. So I can answer your questions as and when they come in. Okay, so let me clean this aspect. So comment below any questions you have. I'll be grateful to answer any questions that you have for me in relation to that. So make sure you comment below with your questions and I'll answer all of them for you. Right, so let's go through, let's continue with our discussion in relation to budgeting. So when it comes to budgeting and budgetary control, what do we mean? What do we mean here? You see, one of the key roles of the management accountant is to assist companies in order to, number one, estimate the cost of a product or an undertaking. Number two, determine the price of a product or a service. Number three, assist the company in setting and making budget and various estimates of the organization. And number four, assist the company in making various investment appraisal decisions. But our focus here is not about just determining the price of a product or determining the cost to be incurred on a product. Our focus here more is on how we can determine and assist an organization in order to estimate the in order to estimate the cost of products or the future cost of products and services that the organization is going to be incurring. And this is fundamental, this is critical for various reasons. So what do we want to start with? Let's start with some key definitions and some key terminologies, and that is going to set the pace for our discussion. So some key terminologies, some key definitions will set the pace for our discussion. So let's start first with these key terminologies, like what is a budget? Like what is budgeting? Like what is a basic budget? Like what is a current budget? Like what is a flexible budget? And then what is a fixed budget? So these are the terminologies that we want to start with in our discussion in relation to the key terminologies that we must understand. So what is budget? What is budgeting? What is a basic budget? What is a current budget? What is a flexible budget? What is a fixed budget in relation to that? So let's take them one after the other and talk about them briefly. So the first thing is budget. What is a budget? Now, according to CIMA, so let's look at some standard definitions here. Okay. So according to CIMA, a budget can be defined as a plan quantified in monetary terms, prepared and approved to a defined period of time, usually showing planned income to be generated and expenditure to be incurred during that period. Okay, so a plan quantified in monetary terms, covering a period of time, usually 1 year, showing the estimated revenue to be generated and expenditure to incur. So for instance, you will say, okay, today I'm going to spend 100 Ghana cedis. That is your budget. Or today I'm going to spend 100 Ghana cedis, and when I spend the Ghana cedis, 100 Ghana cedis, I'm going to be also making maybe 150 Ghana cedis. So you have your expenditure, how much you're going to be spending, and then you have your income, how much you're going to be receiving. That is what we mean by a budget. In a simple language, we say that budgeting, on the other hand, budgeting, on the other hand, is the process involved in the preparation of the budget. Okay, the process involved in the preparation of the budget. Remember, if you are watching and you have any questions, put it in the comment box. I'm going to be answering all your questions for you. There's a master class, so you can throw up questions from all aspects of the syllabus. Whatever subject that it is, you can throw up the question, and definitely we're going to try as much as possible to answer your questions for you in relation to that. So a budget is a plan quantified in monetary terms, covering a period of time, usually a year, showing the expected revenue to be generated and the expenditure to be incurred. Then we come to basic budget. So what is a basic budget then? A basic budget is a budget which covered a long period of time, from which current budgets are prepared. Let me take that again. You see, the idea about basic and current is that the basic budget is a budget pro forma for, say, a period of, say, 5 years or, say, 10 years. And it's about how much money the organization wants to spend in the next 5 years, how much revenue they expect to generate in the next 5 years. And so that becomes like a frame. Now, that is not much detailed. It's just a frame. Now, from that basic budget, they're able to prepare what? The current year budget. So the current budget is a budget that is prepared for a short period of time, usually 1 year, taking into consideration what? The current conditions. So whilst basic budgets are not in detail, the current budget is in detail. Are you getting the idea? So basic budgets covering a long period of time, showing the expected capital to be expenditure to be incurred, expected revenue to be generated, and that becomes the frame, that becomes the benchmark, that becomes the standard against which current year budgets are prepared in relation to that. Then we come to the next one called flexible budget, and then the last one, fixed budget. Now, what is the difference between the two? A fixed budget is a budget that remains the same irrespective of the changes in the output level. So irrespective of the changes in the output level, the budget remains the same. It's a fixed budget. But one thing you must understand is that there is a relationship between a flex budget and then standard costing and variance analysis. Because at the end of a period, if we want to assess an organization's performance by comparing the actual against the budget, it will not be good for us if we compare the actual results with the budget. Why? Because the output levels may be different. So in order for us to draw an equal ground, in order for us to say, okay, 17,000 outputs were produced, this budget is also based on 17,000. Now let's compare. That is where we come to what? The flexible budget. So a flexible budget is a budget that what? Changes with the output level. Why did I take time to talk about that? Because one of the things you must understand, which was actually examined last semester by the examiner, is in the preparation of the flexible budget. Is the preparation of the flexible budget. So let me throw some questions out in relation to how that will be done by an organization. So let me check if we got some questions here. Okay, so if you have any questions, you put it in the chat box, in the comment box. I'm too familiar with YouTube and on Facebook. I forget that we don't do chat here. So comment below with any questions you have. Comment below with any questions you have. I'll be very much excited to answer your questions for you. All right, so let me give you an illustration of the flexible budget. So let me divide my board, and then let me put the budget here. So let's say I have the budget and I have direct material cost. Let's say that's 18,000. Direct labor cost, let's say that's 12,000. Direct expenses, let's say that's 6,000. Let's say we have production, fixed production overheads, let's say that's 5,000. Variable production overheads, let's say that's 10,000. all right. Then let's say non-production overheads, let's say that's also 12,000. Then let's say production units, it's what do we have? let's say 1,000. So this is the budgeted result for the organization. So if this is the budgeted information, let's look at the actual information. So actual. So if I should have the actual information could be, say, direct material cost. Let's say that is 20,000. Direct labor cost, let's say that's 24,000. Direct expenses, let's say that should be whatever, 8,000. Let's say fixed overheads, that is fixed production overheads. I don't know if you can see up to the down here. Let me bring my right. So fixed production overheads, let's say that was 12,000. Then let's say variable production overheads, let's say that's 18,000. But let's say the units produced here, let's say that's 1,200. 1,200. So let me grab my Casio calculator real quick. Hey Jerome, my calculator. Alright, so with my Casio calculator now. So, we have the budget, we have the actual. Then the question is, let's do a variance analysis. So, what we ask ourselves is, how do we go about this? How do we answer this question? I want you to note something here. You see, from our budget, you realize that our production units, we budgeted to produce 12,000 units. But the actual units produced by the company is 1,200 units. It means that the actual units produced is more than the budgeted units. For that reason, we cannot just compare this original budget with the actual results like that and do any variance analysis and make any proper decision. For that reason, we need to prepare what is called a flex budget or a flexible budget. Now, what is a flexible budget? Like I said earlier, it is where we are going to re-prepare the budget, taking into consideration what? The actual units that has been produced. Let me take that again. We're going to be re-preparing the budget, taking into consideration the actual units produced. Because if you compare this 18,000 to this 20,000, you will be unjust to do the comparison because the output levels are different. So in order for us to bring it at par, we're going to prepare a flex budget. So let's look at how we prepare a flex budget or a flexible budget. I'm going to be using those words interchangeably, okay? A flexible budget and then a flex budget. I'm going to be using them interchangeably, but technically they mean the same thing actually. So how do we prepare the flex budget? Simple. So I'm going to slash my currency sign here. We're going to be calculating the budgeted cost per unit, and then we use it to multiply the actual units, and that gives us the flex budget. Let me take that again. We calculate the budgeted cost per unit and use that to multiply the actual units, and that gives us the flex budget. Again, if you have any questions, please feel free to put it in the comment box, and also share the video, and let's see if we can reach as much people as possible if you are getting more value here. So let's begin the journey. The first item there is the direct material cost. Now look at it. Our budget is 18,000, so we're going to put that in brackets. 18,000 divided by the budgeted unit of 1,000. That will give us the budgeted units, budgeted cost, direct material cost per unit based on the budget. Then we use that to multiply the actual unit, and that is 1,200. Are you getting the concept? So let me multiply up for us to see what we're doing. So that's going to be 18,000 divided by 1,000. That should be 18 times 1,200. That should be 21,600. So that is how we get what? The direct material. And then we do the same thing for them. But there is a surprise somewhere. There's a surprise somewhere for you. So look at the next one. Direct labor cost. For direct labor cost, our budget is 12,000. Our budgeted unit is still 1,000. We use that to multiply the actual unit 1,002. So 12,000 divided by 1,000, that's going to be 12 times 1,200, and that's going to be 14,400. You see how sweet it is? Next one, direct expenses. That's still going to be $6,000 divided by 1,000 times 1,200. So let's see what we've got. 6,000 divided by 1,000 times 1,200. That's going to be 7,200. Are you following the concept? Next one, fixed production overhead. Listen to me carefully here. When it comes to fixed production overheads, one thing we say is that the fixed, well, it's an assumption we use, okay? The fixed production overhead remains the same irrespective of the output level. The fixed production overhead remains the same irrespective of the output level. What does it mean then? It means then that when it comes to the fixed production overheads, we're not going to be flexing it. We're just going to pick the same figure in the original budget and bring it under the flexible budget. Let me take that again. The assumption is this: fixed production overhead remains the same irrespective of the output level. For that reason, under the budget, the fixed production overheads we had there, that is the same figure we're going to be bringing here. We are not going to be flexing that, because a lot of students flex all of them. That's why I'm saying that. So we go. So fixed production overheads, we're just going to slot in. How much we got here? $5,000. Slot it in like that. No problem. No cost for alarm. Then we come to variable overheads. So variable overheads or variable production overheads, we're going to be doing flexing that because that is variable. What do we have here? We have $10,000 over 1,000 times 1,200. So let's look at it. It's going to be 10,000 divided by 1,000 times 1,200. That's going to be $12,000. So let's put that down. $12,000. Make sense? Then we come to non-production overheads. Now in this question, we are not told, so let me make it variable non-production overheads. Assuming it was a fixed non-production overheads, we wouldn't flex it as well, but let's say it's variable non-production overheads. So variable non-production overheads, and that's going to be 12,000 divided by 1,000 times 1,200. I think I had that thing up here, 14,400. Okay, 14,400. So this is how we prepare our flex budget or flexible budget. I hope you get a concept. Very simple, sweet, straight to the point. So we are giving the original budget, we are given the actual results, and the examiner said we should do a variance analysis. For us to do a variance, because the outputs are different, the actual output is 1,002, but the production unit is 1,000. For that reason, we need to flex the original budget in order for us to bring it into the actual units basis, so that right now this budget is based on 12,002. The actual results is also based on 1,002, and so if you are comparing, we can now compare it and what? Still get the right thing in relation to that. So that is how we prepare the flex budget. So you can put it down, and then let's continue. I'm going to give you some few minutes, like 2 minutes like that. Then you can put it down for those of you writing. Then we can continue with the flex budget and how we prepare the flex budget in relation to that. So if you have any questions, put them in the comment box. Very much excited. I'll be excited to answer any questions that you are having in a few minutes. All right, so I believe you are through with your writing now. We can now go to the flex budget. So you comment below with your question. All right, Desmond, I see you. So Desmond, I see you. Thank you for the love. All right, so now that we have our flex budget, we also have our actual results. How do we undertake the variance analysis in relation to that? So let's see how we prepare the variance analysis. Okay, so I think let me also snap, because I'm going to rub my entire board. So let me see if I can snap this. Oh, let's see what we got here. Can't find my camera. Can you imagine that? Okay, cover it with my. Okay. All right. So got my image here. Right. So let's go now. So we have the flex budget. We have the actual results. Now let's look at how we prepare the variance statement right here. So let me clean this guy up, clean everything up. Can I do it here? It's going to be squeezing the results like that. Let's make it a bit bigger. Now, in case you did not finish before I copied, you can WhatsApp me on 050-114-9296, and the image taken could be sent to you. All right, so you can use it. All right, so let's see what we got here. Took my image, so I'm going to be using that here. So the variance statement. So how do we go about with the variance statement? Okay, so we're going to be putting the item right here. Okay, then now when I say item, it's the same as the cost element. Okay, it's the same as the cost element. So item right there. Then we're going to be having the original budget. We could bring the, let me just go straight, flexible budget. Okay, the actual results, and then variance. Okay, so flexible budget, actual results, and then variance. We're working in dollars, so we slash that in. Then our items are as follows: direct material, direct labor cost, direct expenses. So let's see, from our flex budget, direct material 21,600, direct labor 14,400, direct expenses 7,200. We're going to be adding that up to give us our prime cost. Then we will have production overheads, and that is into variable and then fixed. And so we have the variable to be 12,000, the fixed to be 5,000 as the original budget, and then that's going to give us the total production cost. All right, then we're going to add non-production overheads, and we had that to be 14,400. So that is from our flexible budget. All right, then the actual results are the actuals we were given: 20,000 here, 24,000 there, 8,000 here. We added up. Overheads, variable, actual 18,000, fixed actual, which we got there 12,000, and then non-production overheads actual, it's 18,000. $12,000 instead, 12,000. I think I didn't give actual non-production overheads, so you can put it there as 12,000. I didn't give that there. So we are done. We are not done though, but like we are done. Okay, so let me make sure the figures I brought here are correct. So let me make sure the figures I'm bringing are correct. All right, so let's punch them out and let's see what we got. So flexible budget, actual results. So let's see. Let's get a total cost here. So 21,600 plus 14,400 plus 7,200. That gives us a prime cost of 43,200. You can also punch that out. Okay, I could make an arithmetic mistake. 12,000 plus 5,000, that gives us 60,200 here. Then we add 14,400 to it, and that gives us the total cost. So plus 14,400, that gives us a total cost of 74,600. Make sense? 74,600 based on the flex budget. On the actual level, 20, 48, 56,000, 52,000 rather. It's right, it's like doing bondelism here. 20, 30, 82,000. Am I sure? 82,000 there, plus 12 will be 94,000 here. All right, so we got our the flexible and then the actual results. So now we can get a variance, which is what we are after all this while. So look at it. Based on the 1,200 units that we produced, we should have spent 12,600. This is why I told you this has a close relationship with variance analysis, because in variance analysis you're actually preparing a flex budget, then you come and do variance analysis, because you're going to be preparing everything or doing the variance based on the actual results. So if you check, we should have spent 21,600, but we spent 20,000. So the variance here is going to be 1,600. Is it good or bad? As you can see, this is a favorable variance. Okay, we spent less than how much we are supposed to spend, so hooray, we did well. Direct labor cost, we wanted to spend 14,400, but we actually spent 24,000. That's huge. Let me make sure I did not take a bump. 24,000, yeah. So let's take it out. 24,000 minus 14,400, and that's 9,600. And that's a huge adverse, because we spent more than how much we are supposed to spend. Then the direct expenses, we should have spent 7,200, but we spent 8,000, so that's 800 more, and that's an adverse variance. Variable overheads, we should have spent 12,000, but we spent 18,000, that's 6,000, and that is an adverse variance. That's an adverse variance. We should have spent 5,000 based on the fixed overheads, but we spent 12,000. That's 7,000 adverse variance. Okay, 7,000 adverse variance. Then non-production overheads, we should have spent 14,400, but we spent 12,000. So that's a savings. So 14,400 minus 12,000. That's a savings of 2,400. And that's favorable. Okay, so let's try to get the preambles out.